We are proud to host today timely and insightful workshop which reflect our shared commitment to enhancing transparency, fostering investor confidence, and raising the standard of investor relations across Kuwait and the border region. Our first session, from global trends to local impact, understanding micro sentiment from the world to Kuwait, will be led by Yab Mayor of Arqam Capital. This session offers a valuable top-down perspective on how global economic trends, geopolitical developments, capital flows, and regulatory shifts are shaping our region and local market landscape. Following this, we'll move to a more hand-on discussion in our second workshop, How to Best Target and Engage with Investors, presented by Sam Ryan of Instinctive Partners. This session is designed to provide practical insights and tools for building and refining our investor engagement strategies, helping you to deepen investor relations, diversify your shareholder base, and align your corporate narrative with evolving market expectations. Together, these sessions aim to empower IR professionals, executive, and market participants with the knowledge and strategy needed to communicate more effectively, respond proactively to market sentiment, and contribute to a more dynamic and resilient capital market in Kuwait. On behalf of Boursa Kuwait, extend our sincere thanks to our partners at MEIRA, as well as our expert speakers and all of you attending today for your ongoing dedication to advancing investor relations in the region. Now, please join me in welcoming Mr. Mohammed Abdal, Chief Corporate Affairs and Communication Officer at Zain Group, and MEIRA Kuwait Chapter Head, who will take it from here.
Thank you, everybody, for coming. I will do my quick session in Arabic because Paulo come after me and I did in English. So for the لا I saw you did very well. But first of all, يعطيكم العافية جميعا، مشكورين على الحضور. نشكر دعمكم والسبورت اللي خديناه منكم طول هالسنين. إن شاء الله يعني راح نضل نستمر supporting IR, the investor relation function in general. قاعد نشتغل مع بعض for long years. Thank you Boursa Kuwait for your support since 2017. بلشنا معاكم واليوم ما شاء الله كل سنة عن سنة we come up with the new sessions with the great speakers, interesting topics. ودنا نسمع منكم بعدين أفكاركم. You have any ideas or thoughts or topics you'd like to discuss for the next session, we would love to take it. اليوم we're lucky to have very good speakers. عندنا Yab coming from Arqam وعندنا Sam coming from Instinctive. There are partners and so many other chapters as well. احنا اليوم عندنا توجه ان شاء الله ان we take the IR to the next level. طبعا Boursa Kuwait did a great introduction of the IR guide. ما شاء الله. Thank you so much for it. And salute to Boursa Kuwait for this. It was a great best practice guidelines for the IR. I can tell you مو عشان احنا بالكويت, it's one of the best IR guidelines with the detailed topics that you can learn, and I think this is a very good start for us. اليوم we want to focus beyond the premier market. We just don't, the premier market are on top of things, the investors, the community that we deal with. I think we should involve more companies with the help of MEIRA support, and thank you Paulo for being always there for us and for arranging for these sessions. Inshallah we will do more together. إذا في عندكم طبعا أي استفسار, any thoughts, any ideas after this, we were more than happy. أنا موجود اليوم مع أختي دلال الدوسري معنا بورد في الميرا شابتر, وعندنا أخوي أمير من MBK أمير حنا هم من الفاوندرز معنا في IR chapter in Kuwait. We're all here to help and support anybody around at any time. Thank you very much.
First of all, welcome everyone. My name is Paulo Casamassimo. I'm the CEO of MEIRA, Middle East Investor Relations Association. Great pleasure to be back in Boursa Kuwait. I'm here today to provide a brief update on what we've been up to at MEIRA, and then we'll leave it to our great speakers. So first of all, shall we start from yesterday? Yesterday we launched in Nasdaq Dubai the CSG IR, which is the certificate in ESG for investor relation officers. We are particularly proud of this achievement because it's the first guide in ESG for investor relation professionals ever developed by an IR association globally. So obviously, first of all, we are particularly proud of the achievement because it's been developed in the Middle East. And second, because as my board say, I'm always very commercially driven, we hope to drive a bit more revenues for MEIRA and to continue to grow in our impact across the region. This year, last year, we've grown membership by over 50%. So we have passed the 200 members across our various chapters, which means we now serve over 600 individuals across the region, and we are particularly proud of this achievement as well. I'll leave it to our speakers now. Jaap will kick off. His session will last 35 to 40 minutes. It will be a little longer. It's a little different this time because, as I mentioned, we like to give you variety. It will cover a macro session, and I think it's very relevant nowadays, given what's happening with tariffs and Trump. And then we go back to our IR with Sam. I hope you enjoy today. Best of luck to our speakers. Thank you.
Yeah, I'll start talking about the global outlook first before I narrow down to the GCC as well as Kuwait later on. Particularly everybody's obsessed. I'll start talking about the global outlook first before I narrow down to the GCC as well as Kuwait later on. Particularly everybody's obsessed. How's the sound effect? Is it okay? Or starts to be okay? Particularly everybody's obsessed about US policy making at the moment. And the narrative of the market has dramatically shifted. Initially, there was a lot of euphoria. And now there's a lot of concerns about tariffs and the impact on global growth, right? So another thing is obviously Doge in terms of savings. They're targeting 1 trillion of savings, which is 3.5% of the fiscal of the GDP, which is halving pretty much the fiscal deficit of the US. So this is a significant headwind to GDP growth as well. Whilst tariffs, if you think about a 10% tariff level, it's about 1% of GDP. If you hit 20%, you're hitting 2% of GDP. So all that together is a significant hit to the GDP growth that we see in the US. Now, the problem is also that because of tariffs, that the break-even inflation levels have dramatically shifted, because obviously tariffs initially are inflationary. Ultimately, I think Christian Lagarde has probably worded this better, is actually longer term, this is deflationary because it's a shock to growth. But the initial effect is that it actually raises inflation. And that's why US Fed is very much, in a wait and see mode before they start acting probably on the downside anyway. But they don't want to act at the moment, given that significant increase in inflation expectations. And we have a good slide about that, which is very interesting. And actually, inflation expectations are really shaping the US Fed policy making. For now, the US Fed actually penciling in 25 basis points rate cuts this year. A market assuming a lot more now, because the market is very much concerned about the impact on growth and really started to price in a recession. Whilst equity markets, in our view, clearly are not yet factoring that in. Actually, valuations are still relatively rich at 20 times earnings. Obviously, we start to see the soft data already dropping quite a lot, PMI data dropping quite a lot, consumer confidence is dropping quite a lot, and particularly consumer is very relevant because it's 70% of the GDP in the US. Obviously, and the question has been raised, is this the end of the US exceptionalism? Are we just in a correction mode, or is this the end of a very long-term bull market that we saw in the US? And it could be down the line, obviously, tariffs are negative for the rest of the world, but it could actually be an opportunity for international markets to start outperforming markets outside the US, including GCC as well as Kuwait. So these are kind of nice snapshots of what the market is pricing in. And the bond markets, I like to look at the bond markets because they really give you a well-informed picture of what the market is actually thinking. So pretty much it prices in almost 100 basis points of rate cuts this year versus 50 basis points implied by the US dot chart. So quite a bearish scenario whereby rate cuts will come through to offset the impact on US growth. And you see trough rates now at the current levels in April are now hitting as low as 3.1%. So we see a big drop in interest rate expectations. But that takes you down to about 125 basis points versus current levels. So the 4.25, 4.5 rate will drop to the low of 3% pretty much over the next 12 to 18 months. So GDP growth is already slowing down on a quarter-to-quarter basis. We're already at the 2% handle. We're probably going to slip below the 2% growth handle. Looking at valuations, you can see that obviously an inverse correlation between 10-year rates and PE ratios. And you can see the market is not per se that cheap, despite the correction we've seen in the US markets. Now, unemployment obviously still around the 4% handle, so the labor market continues to be quite strong. But probably the unemployment rate will probably hit the 5% handle, and that's really will soften the labor market. And therefore, you're not going to have the inflation shock that we're going to see now spiraling into payroll increases. And obviously, that's price hike and then fueling wage growth is what actually drives the secondary order effects and driving long-term expectations for inflation. We see that softening, and therefore that second order effect will kind of soften. Core CPI has been on a positive trajectory, but still remaining above the 2% target. Obviously, financial stress, we saw a significant spike, obviously, but it started to ease as well. The financial conditions have started to worsen around the wobble in the bond markets, but continue to be fairly benign. Now, in terms of impacts, in terms of tariff retaliation, in terms of growth impact, the shock could be significant. We're talking about more than 1% on GDP, and obviously an upward effect on inflation. Actually, these expectations are actually already outdated because the inflation expectations could actually increase in the short term to even 4%. The other thing is to kind of address the imbalances that are very significant in the global economy is that if you look at the fiscal deficit in the US is over 7.5% of GDP, right? The current account deficit, which is 3.5%. So obviously, what happened effectively is that running such a huge current account deficit, the rest of the world starts to have claims on the US, right? So, and obviously Trump is not happy with this and wants to address these imbalances. And obviously his approach is quite unorthodox in a way. So obviously the savings will obviously be a big hit on GDP growth. So you will have that deficit, but also on its own, it will kind of fix off the current account deficit as well. Moving on, these are the charts shows you the term premium, basically the 10-year yields vis-a-vis trough rates of current rates. You can see the term premium has certainly increased, and that's reflecting the uncertainty and the bond markets that we currently see. So this chart is my favorite chart. So when the first rate cut happened, the 50 basis point rate cut, the break-even levels for the 2 years were less than 1.5%. So and if you look at the 1 year, it was only 50 basis points. So that's why, by acting very late, I had to kind of come in with the 50 basis points rate cut last year in September. By then it shot up to already 2.5%, and they continued with 2 rate cuts of 25 basis points, despite inflation expectations already at 2.5%. And now we're still around 3%. So it started to crack already after the tariffs. So initially it was obviously a spike, but actually the growth concerns taking over the impact of the positive impact on inflation that you can see. So, but it's still too high for the US Fed to act. You want to see this coming down to at least 2.5 or even 2 before you start seeing a continuation of the rate cycle. So yeah, so what else is there? Yeah, this is the VIX. Okay, you can see extreme stress in the financial markets, and the worst is already over, right? So the market starts to kind of shrug off the commentary. Also, it's clear that U.S. president is actually a market guy and doesn't want to kind of disrupt too much the financial markets, and he's backpedaling comments on Jay Powell, for example, and you can see the impact just today on the financial markets. So then we move into the other big block, the EU. So if you size it up, US is 58% of global reserves, EU is still 20%, right? So it's the second largest block. And it might take over the reserve currency role. Growth has been very tepid in Europe. Inflationary pressures have been already quite moderate. So there was already room to kind of reduce interest rates. But it was very positively received that Germany started to step away from its austerity and started to earmark almost €1 trillion in spending, which is over 10 years, 2% of GDP. So it's 25% of GDP and a growth boost of about 2%. Now, this debate of whether other countries will actually benefit enormously from this stimulus package, whereby you have, again, a two-tier Europe re-emerging, whereby Germany and to an extent maybe Netherlands will be kind of leading, whereas the southern states will kind of be on the back foot. But there's a lot of mechanisms in place that will not create another scenario whereby credit spread will widen between let's say the weaker names like Italy, Greece, vis-a-vis Germany, because of the mechanism to be able to buy those treasury bonds in the market by the ECB. So that mechanism is in place. And you can see that credit spreads haven't actually budged at all, despite this significant step up in fiscal spending in Germany. So we continue to see, so the growth outlook for Europe is looking a lot stronger than before because of fiscal spending, and interest rate cycle is still looking downwards. And that's started to come through, continue to come through. And funny enough, Spain is becoming like almost in line with the core or semi-core, improving its fiscal position significantly. Whereas actually Italy and Netherlands, Italy and Greece actually have quite high risk premiums, but also it starts to behave much better than before, than history. So in terms of cuts, we see about 75 basis points being priced in. Unemployment obviously a lot higher, but the labor market continues to be quite robust. And there's a lot of, you start to see a lot of wage pressure still. The negotiated wages are still increasing quite rapidly. So there is a bit more underlying inflation risk. But nonetheless, I mean, the inflation levels are a lot lower than we see in the US. With the rates probably, and these terminal rates have started to increase quite a lot. Before, expectation where interest rates would drop to as low as 1.5. Now it's probably going to settle around 2%. So less steep interest rate decline in Europe, and that has strengthened the euro versus the dollar to about 1.15 versus almost parity a few months back. On the UK, UK in my view is also only relevant for people that have maybe a mortgage in the UK, but it's as a global player, it's no longer relevant. I mean, the reserve currencies may be less than 5% of total reserves. There's very little discretionary policy making available, as we saw with the previous government. So there's very little room you can do on the fiscal side, and monetary side is really following what's happening in the US and Europe. So that's basically what you see in the UK. Very slow growth as well. There's a bit of a pickup in UK business activity, but more or less the outlook is very muted, and it's not really a deciding factor anymore in the global stage. So this shows you that the same thing: moderate inflation, moderate real GDP growth. Now China has been interesting because obviously the impact on tariffs is one thing. Obviously, if you size up the US exports for China, it's about 2.8% of GDP. So obviously that could be a big shock to GDP growth, which is already around the 5% handle, right? So you could potentially halve your GDP growth. But the export growth to other countries is so strong that it's pretty much 2 years of export growth, right? So it is actually absorbable. And China has the capacity to kind of stimulate the economy as well, given the current account surplus that it still has of about 1.5%. At the same time, the fiscal space is not unlimited. Fiscal deficit has reached already 7.5% of GDP. So there's not a real quick fix. And we think that China's growth will continue to kind of slow down, and over time, even to the 3% handle. And potentially the 5% handle that we currently see is actually overstated. Actually, look, if you size up the underlying data from the economy, we assume that the GDP growth may be as low as 3%, actually. So obviously, we saw the Chinese equity market doing really well. And that's basically because, the IT companies started to do extremely well in terms of new agreements on AI. Alibaba, for example, had new partnerships, and they were really in a tough corner before, whereby there was a lot of crackdown, etc. And these firms are trading at 10 times earnings, right? For Alibaba, they can buy the stock at 10 times, unbelievable, given the offering that they provide. So the Chinese equity market started to do quite well on the back of that. Now, interestingly, if you look at the bond data, I mean, it's pretty much prices in a deflation. I mean, 10-year bond yields are as low as 1.6%, which is pretty much at Japanese level at the moment. So the economy is extremely frail. You can really see that. So that's why we don't really buy the economic growth data, because I think the economy is much weaker than they actually portray it is. Inflation is really becoming negative, and producer prices are actually declining. For Japan, it's relevant to look at it from a carry trade, because we estimate about $1 trillion of carry trade happening, whereby you borrow in Japanese yen and invest it in higher yielding countries such as the US. Particularly when the yen were to strengthen, that we could see an unraveling of those positions, and that could disrupt the financial markets. So for now, the yen has been weakening, but obviously Trump is now calling for the yen to strengthen, which could be a risk. Gradually, the interest rates will be increasing. So we think at one point the yen will definitely stabilize and potentially strengthen. And we saw a significant increase in bond yields in Japan as well, from very low levels. As you can see in this, I think this is, yeah, so if you look at the light blue line left at the top, you can see it increasing from, the chart is gone. It's now around 1.5% or even over. So from very low levels. Whilst inflation is still around the 2% handle. Most of that inflation is actually not because of the domestic economy, it's really because of imported inflation, because of the weak yen. So the argument is, there's debate between the central bank and the Ministry of Finance about where is inflation really coming from, and the domestic side is certainly not driving the inflation that we currently see. So this kind of limits the upside of interest rates. I mean, we're probably not going to see more than 1.25% of interest rates in Japan. Now, gold has obviously been, and obviously, I think this chart is probably 1 week old because we hit 3,400 already. And it's been the perfect currency. A lot of things are happening. Obviously, a lot of countries are starting to shy away from US government bonds, such as China and to some extent Japan. I think, and also central bank have been buying gold basically as a hedge for what's going on. So I think that has been the key driver, and the weaker dollar, obviously, naturally, is pushing up gold prices. So it's been a perfect asset, as opposed to silver, which is more an industrial commodity, right? There's obviously people like to look at the ratio between the two, but actually, effectively, silver is a commodity. It's more like an industrial commodity rather than a safe haven. On oil, obviously, it started to look very dangerous at one point. When OPEC Plus announced its production increase of accelerating basically the monthly unwinding in one go for 3 months, at a time when there was a lot of growth concerns happening. So the oil prices collapsed, and people were really fearing that oil prices would reach the mid-50s or even below. But actually, hasn't been as bad as expected. Oil prices have behaved, and we're still in the mid-60s, which is still decent for the GCC. Particularly, the news came from International Energy Agency, which is representing mostly the consumers of oil. They scaled back their demand growth forecast as expected, but probably to unrealistically low levels. They're penciling in 0.7 million barrels of growth, whereas in Q1 we had 1.2. So they seem to price in, or let's say, penciling in a significant deceleration in growth. And secondly, more importantly, was actually the reduction in oil supply outside OPEC, which was reduced by almost 300,000 as well. So it's kind of, even though demand falls back, you don't have the significant growth in oil supply as well outside OPEC. So it's kind of more balanced than what was expected. And the latest data out of last week was actually that we start to see significantly improved compliance within OPEC, with Kazakhstan, Iraq, and UAE actually now in line with the quota. So that's kind of stabilized the market. And also, obviously, Donald Trump wants to increase US production by 3 million barrels a day, which is going to be very difficult. In fact, IEA scaled back its production growth mainly for the US because of the impact of low oil prices at the moment. So break-evens are like 65 or higher because of the easy wells, the low-cost wells have already been tapped, right? So you don't see that significant increase in production anymore out of the US. So that's why the oil outlook is actually looking a lot better than initially feared, even though the market will be still net better supplied than we had last year. And then obviously the wild cards are sanctions against Iran. And we think that potentially maybe the OPEC Plus production increase was actually kind of ahead of potential announcements kind of to squeeze Iran in the corner to kind of come to the table, as well as potentially Russia to kind of put pressure on to get Russia to a deal with Ukraine. So in terms of break-evens, obviously, Saudi is around 90, UAE is around 60, Qatar is probably 50 and dropping to 45 because of the gas. Bahrain is obviously very high. Oman is around the 65 handle. And Kuwait depends on how you see it. So obviously if you include the returns on the sovereign wealth funds, it's very low. If you include it on a cash basis, probably above 80 or even higher. All right, so, but obviously we're not too concerned about Kuwait because of the new bond program. So it gives a lot of fiscal space to kind of do the project spending that's needed. In terms of impact on tariffs, it's really going to be concentrated on Mexico and Canada, whereby we could even see a huge impact on their GDP growth. The impact on China, probably 1%, maybe 2%. Well, this should be updated. Maybe the impact is more like 2%. And inflation is about 1 to 2% on the short term. And global growth probably dropping below the 3% handle, as IMF was saying. So these are the scenarios. So you can see the huge impacts on a one-year basis on Mexico and Canada, the worst affected, because they really rely on exports to the US. So you see this huge exposure coming from these countries. And obviously there's a lot of economic uncertainty around these countries. Yeah, and in terms of hike cycle, actually US and EU, as I said, are on a downward trajectory. And actually Brazil started to defend its currency and actually had to increase its interest rates, and the same applies to Turkey, actually, whereby there was a lot of political unrest, and to kind of protect the currency, the interest rates were actually going up. This is the impact on, let's say, the industries. Motor vehicles obviously massively impacted, machinery, petroleum as well, and electronic equipment are the most affected with over 2% reduction in global demand. So if looking at zooming in onto the GCC, I mean, if you strip out oil production, actually, the growth has been quite high, actually, the last few years. Particularly UAE has been actually having growth rates of 5 to 6%. So it's since 2020. So it's a massively positive trajectory. Saudi is running also plus 4% plus growth rates, whereas the rest of the GCC is running around the 3% handle. For Qatar, maybe 2%, and the rest more around the 3% handle. So it's kind of a conducive growth environment. Obviously, the talk of the town is obviously what's happening in Saudi Arabia, whereby the deficit could potentially hit, depending on the oil prices, obviously, maybe 7% of GDP, and there's a 60 billion of funding that we need to look at. There's a lot of options. I mean, there's SAMA reserves north of 400 billion. PIF has over 900 billion of assets, an equity portfolio which is worth 460 billion. So there's a lot of funding options, and also you can tap into the international market as well. So there's much more activity in loans and bonds, particularly in the Asian markets. So there doesn't have to be a fiscal cliff per se. Nevertheless, I would say that Saudi Arabia is still the most vulnerable from the GCC, because if you backtrack historically the GDP growth, how much was driven by fiscal spending? Right? I'd like to look at that ratio. For the UAE, it was the lowest country. And there's only 20% of GDP growth was actually driven by fiscal spending. And fiscal spending is not driven by oil revenues that much. The correlation with oil prices and fiscal spending is almost zero. And only 20% was coming from fiscal spending. So 80% was driven by private sector, right? So and it's driven by institutional changes, obviously. Whilst Saudi Arabia is very much the opposite, very much a different economic model, which is very much top-down driven. So historically, obviously, it was a huge boom bust, right? Obviously, in terms of oil prices and fiscal spending. But as much as 70% of non-oil GDP growth was driven by fiscal spending. So when this is going to slow down, I think growth in Saudi will be starting to slow down as well. Now, in terms of Kuwait, obviously, it's coming from a very low base. Reform momentum is really driving it. If you have 100 billion of bond issues, it's 50% of non-oil GDP, right? So it gives you a lot of fiscal flexibility. And obviously the housing law is going to be a major game changer, as we saw in Saudi Arabia. And if you look at the international markets, then the home loans can be more than the corporate loan books, right? So it could be a huge game changer. Obviously, we can debate how long it will take, and is it going to be a 10-year process, etc., before everything is built, etc. But I mean, it's for sure the growth outlook improves significantly. In the housing market is a massive driver of GDP growth and employment. So that's clear. Qatar is slowly turning the corner. There was a lot of overbuilding around the FIFA. The economy is very small. Qatar obviously has massive buffers, certainly for the size of the country. And it's slowly turning the corner in terms of available liquidity as the Qatari banks had to get rid of a lot of non-domestic funding. Government borrowing started to drop quite a lot. And there was a lot of asset quality issues because of the overbuilding and payment behavior. It started to slowly turn the corner, but it's been quite slow. But you start to see that the asset quality situation is improving. Liquidity in the system has been improving. So that's positive. Oman is obviously on track to kind of copycat what's happened in UAE, Qatar, and obviously we saw Kuwait and Saudi following in terms of upgrading to emerging markets. And Oman is really keen to do this as they privatize more and more state assets. For the moment, it's a very illiquid market, very little trading happening. It could be another one that could be part of the emerging market universe. Strip out oil, the real GDP growth has been very robust, as you can see. So these are the growth rate for Kuwait. Obviously, gross debt to GDP can set to increase quite a lot, which is good to kind of build a curve in the financial markets. As a fiscal account, if you include the surplus or the returns on the investment funds, actually are still very massive. Balance sheet growth already started to pick up quite materially for the banking sector. So we saw like very low single digits back in 2023. Now it started to pick up quite nicely. And that's not yet matched with deposit growth. So the liquidity is actually tightening in the system. What else is important to look at? The share of government deposits in the system. As we said, Kuwait is not that vulnerable for oil prices, so we don't think that's a big risk. But we're obviously monitoring how this will affect available liquidity, lending opportunities, etc. So yeah, obviously we're bullish on. Obviously, you guys had a nice call. I think it was yesterday or not. Obviously, you start to see a slight slowdown in project spending, but obviously you're still optimistic about what's coming through. You start to see 10 billion KDs in spending this year, which is a significant step up what we saw the last few years. So that's driving economic growth. Optimistic about the new mortgage law. And in our view, it's going to be very positive for the banks, because if you can make 2% credit spread on a product that will be 35 or maybe 25% risk weighted, it's going to be very attractive. And then the problem for us is more the liquidity, how the fund is. But the spreads are high enough to kind of being able to think about, funding options like senior bonds or down the line an RMBS structure, for example. You're actually allowing that to happen. Rather than what we saw in Saudi, whereby rates for mortgages were as low as 4%, and the bank that took all the market share, which is Arashi, had to pay up for significant margin pressure down the line. So I think it looks like it's very promising, I think. So we play the banks, obviously, on the back of this. Obviously, oil production is going to be up, so oil revenues will go up. Corporate taxes will be another lever for tax revenues, which is going to be positive. And potentially we'll see a VAT at one point to kind of improve the cash fiscal break-even. So this is the budget, as you well know. And obviously, this is obviously the big picture is the weight of Kuwait in the emerging market index. Obviously, it was first included in the FTSE. In 2018, 2020, we saw the inclusion in the MSCI index, which is more relevant in terms of tracking, with anyway, more passive tracking, but much more active tracking. And it has steadily improved. And obviously the market performance, obviously the KFH AOB merger helped as well in 2022, which was a major event. And then the weight increase is really because of the market performance. And in fact, Kuwait is the best performing market here today, right? Because of all the reforms that are happening. And we start to see significant inflows as well from foreigners year to date. So obviously already surpassing the levels of last year in the first 4 months. and it has the momentum has kind of continued to improve quite nicely as Kuwait becomes very much investable. And this plots you against in dollars terms, but also as percentage of the free float market cap. So some names were even seeing inflows of 10% of their free float market cap, which is very significant. So it's good to see this happening. Lots more attention from foreigners into Kuwait, because traditionally, let's say investors were only in UAE, to extent Saudi, maybe a little bit in Qatar, but Kuwait was definitely not front of mind. So this is really changing, and particularly the banking sector has been played a lot in terms of the biggest flows. But we see actually inflows across the board happening, which is very positive. So in conclusion, is this the end of US exceptionalism, or is it just a correction? We could be seeing a renaissance of international markets. Valuations are much lower in the US, for example, and the growth outlook might be actually looking stronger. I mean, if you look at GCC, it's actually growing at 3, 4, 5%. For sure, it's beating the US markets, certainly beating European markets. And actually, in my view, it's beating China as well, because I think the real GDP growth in China is much lower. We're still having a downward trajectory. It's just a matter of timing. I mean, the rate cut probably going to happen by June, by which at that time the market becomes a bit more concerned about growth, that inflation expectations will have dropped. So we see that happening. The higher rates in Japan could affect the carry trade, but probably Japan will choose a very cautious approach. So we don't think that's really going to hurt the market. China becoming more investable, to be honest, at the same time. So as an emerging market investor, that could be an alternative. You always kind of compete with other ideas in other markets. And in terms of strategy, we've been actually, we kind of put actually more risk. We thought actually there was a lot of dislocation in equity markets, so we put in more risk in our core portfolios. But at one point, if let's say the long-term rates in the US were to drop, let's say to 375, because if you have a term premium of 75 and rates will drop to 3, it kind of makes sense, if you have moderate growth. So you could make a bet more towards defensive names down the line. But for now, if 10-year yields are at 4.4, you don't really want to make that call. And obviously, Kuwait benefits significantly from the institutional reforms. It's not all about incremental fiscal spending. Obviously, it helps in terms of project spending to kind of cater for this, but it's all about institutional changes. And it's really driving the significant inflows into the country. And the next one is probably going to be Oman. But to be honest, it's going to be a 2027 event with probably people playing it only next year. So it's just too early to play, as we see the equity markets really struggling, actually. Thank you.
All right. Tough act to follow you up. A little bit different from my end. It's going to be a bit scripted. But first of all, it's great to be with you all here today in Kuwait. And again, thank you, Paulo, the MEIRA team, and our host here in Boursa Kuwait. So I want to take this session to kind of take a slightly more strategic lens to investor targeting and investor engagement. And I mean, coming at it from a point of view is not just a checklist from an hour perspective or a campaign, but something much more fundamental, rather a way that you can deliberately shape the investor base the way you want and build the investor relationships that will support you guys through the cycle. And this is something that's often talked about, but in practice, many IR teams that we've worked with and we've seen still struggle to this day in the region with how to do it in a focused and repeatable way with a strategy. So to start with the basic question, so why target, right? So investor targeting is exactly what it sounds like. Identifying which investors you want in your shareholder base, right? And then putting a plan in place to actually target and reach those investors. So in a region where I think, Yap, you've mentioned, and a couple of people here in the audience have mentioned that liquidity can be limited in Kuwait, in Abu Dhabi relative to KSA, for example, and markets are still evolving. The composition of your shareholder base it really matters a lot. And I stress on matters a lot even now, right? As foreign capital is starting to come in. So the difference between having a base that understands your business model versus one that's chasing quarterly momentum becomes clear in moments of volatility. So this is about more than just filling the register. It's about building a shareholder base that's aligned with your strategy, your corporate strategy, that's patient, capital that's patient, and that gives you space to execute. And good targeting is obviously structured, right? So It starts with knowing your current base, you identify gap, and you set a roadmap. So a few key benefits: it can lead to more institutional investors and better quality investors. It often drives increased QFI, so that's qualified foreign investor participation, especially when targeting is tailored to specific regions. And it also helps IR teams to track their own KPIs by tying activity to changes in the register. And to extract these benefits, obviously, a good targeting program typically means that you have to have a good calendar that pre-allocates the management and the C-suite's time for engagement. You have to have a strategy that must be data informed based on a register analysis, and most importantly, follow-ups and tracking, because honestly, targeting without monitoring is just guesswork. And the challenge, of course, is translating that ambition into a process. So what you see here is a practical methodology. What you see here is a practical methodology that takes the guesswork out of targeting. It starts, as it always should, with the share register, the one that you extract from your exchange. And that's not just the top 10 holders, but out of a detailed view of what's changing. So who's buying, who's exiting, and what that tells you. And then you expand the lens. So you look at who's holding your peers, who's active in emerging markets, and who's active in your sector globally. And it helps you build a real prospect universe, not just a wish list that you jot down. So from there, we go on to profiling. That's where the data gets nuanced. You ask questions like, is the investor short-term or long only? Is he ESG driven or deep value? What are they looking for in a management team, in disclosures and in capital allocation discipline? This can inform prioritization when you guys want to prioritize the target list. And then you rank it by fit, not just by size. And some of the best long-term holders aren't actually necessarily the largest funds. And then obviously we coordinate internally across listed subsidiaries, if applicable to you guys, if you're a holding company that has listed subsidiaries under you guys, just to avoid overlap. And finally, you move into a tailored engagement. So just a small message here. When you speak to a sovereign wealth fund, for example, in Asia, the message won't be the same as what you present to a tech-focused small cap fund who's based in the UK. So I'd say targeting is work, but the point is to target intentionally and not opportunistically. So before you target anyone, you need to understand your own investment case. You have to have an inward-looking view. And that sounds obvious, but I can't count how many times I've seen companies in the region skip this step. And we say, oftentimes we hear IR teams say, we're undervalued, our multiple is low. We're undervalued, our multiple is low, but undervalued, ask yourselves, compared to what? Or compared to who, right? So it's important to understand this because the type of investors that you attract will depend on the profile that you project. And again, the goal is to attract long-term investors that are aligned with your equity portfolio and have also the right mix with the retail base for liquidity. And also, since these investors hold similar companies to your own and your peers, you can maximize the ROI on your management's time by meeting investors that are ready to invest in your company. And here we've taken an example of a telecom company, just a sampled example. We first looked at key regional peers and then expanded into international peers who are in the telecom sector. And these peers likely have investors that are actively investing in the sector and understand your industry. And then looking at those regional peers also confirms that these international investors are also able to invest in your market. And then we take a broader view. We expand the peer search to listed companies that are not in your sector. So you can see here companies like Ma'aden or Amar, which is not relevant to telecom in any case. And we look for peers that are in the same market cap category, which have a similar valuation. So you can add more filters to kind of fine-tune the search to be more aligned with your equity story. For example, you could look at peers with a similar growth rate or a similar dividend yield. The aim here is to ultimately identify generalist investors that are looking to invest in companies with a similar equity profile to your company. And this kind of mapping really helps you understand what kind of investors are holding your peers, and it allows you to expand your search beyond your sector. And from there, you ask, who are the investors that invest in companies similar to mine? And that's who you want to target. And then let's talk about data. So most IR teams in the region do have access to some form of shareholder tracking, but few really are using that data to shape the targeting strategy in the IR functions. And I get it. Look, data can be dense. It's not always clean. But if you really know what to look for, it does become a powerful tool in my view. So I start with geography. Are you over-indexed in one market? Are you underexposed where your peers are strong? I look at holder type. Are you too retail heavy? Are you overweight passive? I look at recent behavior, for example, who's quietly adding, who's exited after your last quarterly call results, and why, right? It's important to ask the question why. You can even start correlating investor movement with your own internal performance metric. And then there's watch lists. So investors who haven't engaged but are showing up in fund flow screens or even peer holdings. So I think when used right, this kind of insight gives you a data-driven narrative for who to approach, how to approach, and then when to approach. So then going deeper into the register, I think because not all registers or register analysis is actually equal. I think this type of analysis is done by downloading your register data. So this is not analysis from companies like Bloomberg and S&P Cap IQ where you can pull the peer data. This is your actual share register that you pull from the exchange, right? So this gives you the information on regional and retail base with the specific NIN numbers of the investors that oftentimes, as I said, doesn't show up in platforms like Bloomberg or S&P Cap IQ. I think it's not enough to know who owns you today, but you actually have to understand one level deeper, how long have they held the stock, right? So another question, what other names do they hold alongside yours, or what triggers movement in and out? So if a quarterly call happens or a results announcement happens and suddenly you get dips out of the stock. So it's important to kind of analyze that and actually track it. So again, a good register gives you a view beneath the surface. If we go one level deeper again, we can kind of go down to the fund level to allow you to connect, if needed, with a specific portfolio manager, for example. So you'll see here an example of where we rank top holders by net change, not just by AUM or by size. And this is, I think, key because sometimes a mid-sized fund increasing their position in your company is really more meaningful, or it's a more meaningful signal than just a top holder staying flat. And if you're about to go on a roadshow, this kind of insight gives you huge advantage. And you can go in knowing who's already building a position and who may need a fresh conversation. So once you've gone deep into your own share register, the next question is, how do we compare to our peers? So this kind of shows what the initial analysis can look like. Here we've mapped peer shareholder data for a telecom company. Again, this is a sample telecom company, alongside sector names like AT&T and non-sector names such as MR. So what you're looking at is the market value of institutional holdings across your peers, each one giving us a window into who's active in the sector. I think it's valuable for two reasons. So first, it gives you a benchmark. You can see where you may be underweight relative to your market cap or entirely even missing from institutional portfolios where your peers are already well represented. And second, I think it helps you spot potential target investors who are active in the space, but not yet in your name. So it's kind of like a portfolio puzzle where if they hold similar stories or equity stories or profiles, they might be open to yours. So, but you won't know unless you really check and you really dive in. So I think it's not just about top names also. Sometimes you'll find, again, as I said, mid-sized institutions with strong conviction positions in your peers. And those are really high probability targets for you guys. And this is where the real targeting starts to come into focus. So here we've aggregated investor level holdings across multiple peers based on the percentage of the float, or rather free float that they hold. So it shows very clearly who's overweight, who's underweight, and who isn't holding you at all. So this gives you a data-driven basis for prioritization. So it's no longer casting a wide net and saying, let's just meet big investors as the head of IR or as the C-suite. It's actually saying, let's meet the ones that have a clear rationale to engage with us, people in our sector who understand our story, and where we know what story might resonate with those specific investors. So once you've built this list, you can start building your targeting categories and forming a real engagement plan. So categorization is the final filter before actual engagement with the investor. So what we're doing here is sorting investors based on the relationship to you and your peers. So we examine their holdings relative to your market cap and your peers' market cap. So you can see category A, these are the guys who are your supporters. They hold a large share in your company relative to peers, and they believe in your investment case. So these are the guys who've also done the homework and they understand the sector, but they may sometimes need frequent contact and updates when you have a material event. You'll need to make an effort to keep them engaged and to ensure that they maintain their overweight position. In category B, these are the shareholders who are underweight your shares, yet they're overweight in peers or the sector. These investors have the potential to increase their holdings in your company, but likely require more engagement for them to understand and actually believe in your equity story. Then you fall in category C, which are targets that are top holders of peers, but not in your name yet. So they're already done their homework. They understand the sector. They just may have not seen your story or haven't seen it clearly enough. And they may require engagement to develop trust in management and in your investment thesis. So this framework kind of sharpens your engagement strategy and not treating every investor the same. It's how I think IR can become more of a strategic lever rather than just a reporting function in an organization. So once you've defined your categories, the next layer is obviously geography. So where do these investors actually sit? What regions require more effort to engage investors? This example gives you kind of a breakout across Canada, the US, Europe, and Asia. It's really real world mapping that helps build out the targeting calendar later on. But it's also, this kind of has a strategic benefit also because geography often tells you something about the investor behavior, sometimes not always. So for example, if we generalize at the very super high level, we can see that European investors, typically the stereotype is that they generally have a larger, longer term horizon and offer more governance sensitive and more focused on ESG. Whereas Asian investors, for example, are highly selective, but we're seeing that they're increasingly active in the GCC. So when you're building your outreach plan, this helps you match investor expectations with the story that you're telling, and it helps you with scheduling with the C-suite and resource planning. So if half your targets, for example, from the exercise you've conducted are in Europe, you're not going to build your calendar and base it off of North American events, for example. So shifting gears now from targeting to actual engagement execution. So once you've identified who you want to meet, you also need to structure, and you need to have a structure to determine how to meet these people. So this example lays out a real world approach to meeting prioritization. Investors are scored and ranked not just by size, but by influence, register impact potential, and strategic alignment. So tier one investors are offered one-on-one meetings with C-level executives. These are the big bets, the ones who could move the needle. Tier two, often promising but less critical, are offered similar group meetings or senior time with IR. And some meetings can be bundled or pushed later to a date, but that's not to neglect, rather just more to focus. It also reduces executive fatigue, it enhances meeting quality, and ensures that the IR team is using management time wisely. So you've built a target list, you've mapped out your outreach, and you've structured the meetings. Now you need to think about where to meet them. So this shows a mini kind of sample calendar of investor conferences, and the key is that they're not just random events. So each conference should be selected because it aligns with the geography and investor type from the targeting work that you've done earlier. So for example, EFG or MEZ in Dubai, which happened a couple of weeks earlier, that's great for reaching regional and EM focused global investors in addition to the regionals. Then you have Morgan Stanley in London, which is a bit more institutional, high quality exposure to European based funds, and HSBC in Hong Kong, for example, relevant for Asia outbound investors. So you obviously don't have to attend everything, but each event should have a clear objective. So who are we meeting? What messaging are we reinforcing? And what follow-up do we need to track? And this is how you turn the events into outcomes. So going into non-deal roadshows, or rather NDRs, this is one of the most direct ways I think companies can influence the shareholder base by proactively meeting the right investors at the right time with a clear purpose. But they're not really easy to pull off in many cases. So they often require internal resistance, or they face internal resistance with management and C-suite. That's due to scheduling conflicts, executive bandwidth, or questions about ROI. So it really takes effort and coordination. But I think what it shows is that despite those challenges, the payoff is worth it if it's done right. So a well-targeted NDR can drive results through higher investor interest, improved register composition, and also possibly stronger secondary market liquidity. And just as importantly, it gives you a direct feedback. So investors are much more candid in a room, as you know, than they are in a call. The key is to design an NDR around your targeting strategy, not just around geography or convenience. So what does a strategic NDR look like in actual practice? So it starts with the data, obviously. So who do we want to reach and where are they based? Then we define the objectives. This is about introducing the equity story to new investors. Are we reinforcing confidence post results, or are we preparing the ground for future issuance from a corporate perspective? Then from there, we build the engagement format. So that's in-person versus virtual. Is it one-to-one versus group meetings or CEO-led, or is it just IR-led? Then we also tailor the content that we're delivering. So not just a standard deck, but supplementary materials. So a narrative that actually ties to the market trends and talking points that align with the actual investor profiles that you guys set to meet. And then finally, frequency, right? So many companies that get this right, I think, run at least 2 NDRs per year, at least I'd say, if you have the capacity. And they're often mapped to key strategic windows in the organization calendar. So NDRs require alignment across your entire internal stakeholder map, and this kind of breaks down who can be involved and how. So obviously the CEO, the CFO, and the key C-suite are essential for investor-facing meetings, but behind the scenes, sometimes you've got legal and compliance vetting content, you've got strategy and finance refining the narrative, and then you've got subsidiaries, again, if applicable, especially if you're listed, aligning on joint messaging. Then, of course, the IR working group does the heavy lifting in the background. So that's coordinating logistics, preparing briefing materials, and also capturing the insights and the feedback. I think what we've learned is that most effective IR teams treat NDRs like mini campaigns. So everyone kind of knows their roles, prep is done in advance, and there's a clear post-roadshow debrief. It helps ensure that time, especially executive time and C-suite time, is invested in a way that's really high impact and repeatable. So bringing it all together, I think smart investor targeting is about having a process that's insight-based, that's iterative, and that's aligned with your strategy. So we turn underweight investors into advocates, benchmark and map, not just against peers, but against where you want to be. Then we continuously refine and deliver, and monitoring is key here. And then we target, so we monitor investor sentiment also, the changes in those investor sentiments, and then the market shifts. Obviously, strategies evolve in your organization, and your engagement plan has to move with that and evolve with that. And the core of all of this, I think, is clarity of the investment case. So honestly, if you guys as head of IR don't know why someone should invest in your company, neither will they, right? So we need to align messaging with the fundamentals, lead with strengths, and close with confidence. I think really, especially in our markets in the GCC and here in Kuwait, the IR teams who win in the end are the ones who lead. So I think I will close this off. So I hope this gave you not just a framework, but a mindset where investor targeting is part of your day-to-day. Hopefully we'll see it in Kuwait more often with NDRs planned externally in the UK, possibly in the US. I think if we look at IR more of a strategic function, and I think we really do need to look at it as a strategic function, then targeting and engagement are the front lines in that. I think this is an effort that you guys have to push internally with your management and with your C-suite if you want to drive this. Thanks again to MEIRA and Boursa Kuwait for hosting, and special thanks to Fahad and Paulo. Thank you.